Imagine a global financial system that operates without charging a single cent of interest. Sounds almost impossible, right? Especially when we're so used to conventional banking, where interest rates basically dictate every move the economy makes. Yet, there is a multi-billion-dollar financial system out there operating entirely on this exact premise. So, how does it actually work? How does it make money? And how in the world does it handle things like late payments or funding massive national infrastructure?
Welcome to This Explainer. Today, we're demystifying Islamic finance. We're diving straight into the source material to explore the strict ethical mechanics that drive it, how it scales up to a massive national level, and the cutting-edge innovations that are pushing it into the future. It's this incredible intersection of ancient philosophy and modern economics.
Here is our roadmap for today. We're going to start with the principles of ethical finance, navigate through debt and default, check out sovereign sukuk in action, explore the world of green investments and fintech, and wrap up with how this space is innovating for the future. Let's jump right in.
Section 1. The Principles of Ethical Finance. This is a system where the absolute bedrock is benevolence and social justice. To really grasp this, you have to understand a central concept called Qard al-Hasan. Essentially, this translates to an acceptable or good loan. And here's the kicker. It is a completely interest-free, benevolent loan. In a Qard al-Hasan transaction, if you borrow money, you only repay the principal amount. Not a single cent of markup or interest is charged. It's totally untouched by riba, which is the Islamic term for interest, and it's primarily used as a tool for welfare and solving real problems within communities.
And the roots of this go incredibly deep. The Quran literally puts the giving of a benevolent loan right alongside regular prayer and charity. So you can see it's not just a standard financial transaction. It's considered an act of faith, a way to redistribute wealth and support those in need, completely removed from the wild fluctuations of the market.
Another huge pillar of this ethical foundation is Waqf. Think of a Waqf as a perpetual social finance institution. Here's how it works. You donate a fixed asset, maybe a piece of land or a building, and the financial returns from that asset are continuously reinvested or used to fund charitable services, like education or healthcare, for generations. A famous historical example in the text is the Al-Azhar Mosque and University in Cairo, established in 1908. It literally transformed social capital into permanent social infrastructure. Okay, but let's be real. What happens when someone just doesn't pay? That brings us to Section 2. Navigating debt and default, and the very strict rules around repayment. This is where the contrast gets kind of mind-blowing. In conventional banking, if you pay late, you get hit with a fee, right? The logic there is opportunity loss. The bank wants the money they could have made if you had paid on time. But under strict Sharia guidelines, financial compensation for late payments is absolutely prohibited. You cannot charge a borrower extra just because they missed a deadline. Now, before you think this sounds like a free pass to ignore your debts, hold on. Ethical doesn't mean loose. Delaying payment when you actually have the money to pay is strictly prohibited. And here is the truly fascinating part. If a contract does include a penalty to discourage late payments, the bank doesn't get to keep that money as profit. They are legally mandated to donate it to charity. It prevents moral hazard without enriching the lender. Sure, institutions can recover actual out-of-pocket recovery expenses or sell pledged collateral, but they cannot profit off a default. Moving on to Section 3, Sovereign Sukuk. How do these ethical rules actually scale to national economics?
To put this into perspective, 63.2 billion US dollars. That was the total issuance of Indonesia's sovereign sukuk, known locally as Sukuk Negara, in just a single decade up to March 2018. We are not talking about some niche alternative here. This is a massive, multi-billion-dollar financial instrument being used to fund major national infrastructure.
If you look at Indonesia's milestones, it's just a masterclass in consistent, aggressive growth. They went from their debut domestic government auction, expanded into the retail sector, then into global sukuk, and eventually launched the world's very first global green sukuk by a sovereign entity. They utilized everything from project-based structures to savings sukuk. It really goes to show how incredibly versatile this system can be while still strictly adhering to Sharia principles.
And mentioning that global green sukuk is the perfect transition into our fourth section, green investments and fintech. Let's see how this ancient ethical framework is adapting to our modern future.
Technology is completely revolutionizing how these ancient rules are applied today. Because Islamic finance demands total transparency, Sharia-compliant fintech is utilizing things like smart contracts to automate compliance and completely remove ambiguity. You've got blockchain stepping in to decentralize control, and AI and RegTech monitoring transactions in real time alongside digital banking and crowdfunding. It's making the whole ethical finance space faster, smarter, and vastly more accessible.
Plus, there is this massive, undeniable overlap between Islamic finance and the booming green investment sector. When you think about it, both systems fundamentally prohibit investing in harmful industries. Both focus heavily on ESG, environmental, social, and corporate governance. This synergy has sparked a huge wave of products. We're talking ethical mutual funds, green real estate funds focused on sustainable living, and Sharia-compliant microfinance to support eco-friendly small enterprises. Together, they're becoming a real powerhouse for funding UN Sustainable Development Goals.
But reaching this level of seamless integration doesn't just happen by magic. It requires deliberate engineering, which brings us to our final section, innovating for the future and training the next generation.
Looking at course materials from industry training institutes, a pretty harsh truth emerges. If you fail to continuously innovate, these financial products just become inefficient. The professionals running these systems have to be trained to walk a really complex tightrope, balancing modern central bank regulations on one side and strict Sharia standards on the other. They can't just take a conventional banking product and slap a new label on it. They literally have to engineer genuine ethical alternatives from the ground up.
And that kind of human capacity development is being spearheaded by centers of excellence like BELIF, the Brunei Institute of Leadership and Islamic Finance. By bringing together regulators, Sharia committees, and business strategists, they make sure the workforce actually knows how to bridge bold financial ambition with enduring strict ethical values.
So, practically speaking, how do they actually create these new products? Well, the curriculum breaks down a few specific techniques. First, professionals learn to modify classical contracts, basically updating historical operations to work in the digital age. Second, they practice amalgamating, or combining, multiple Sharia contracts to handle the complexity of modern financing. And finally, there's new ijtihad. This is the big one. It refers to completely fresh, unprecedented innovation based on independent scholarly reasoning. It's a highly structured evolution, taking plain vanilla concepts and turning them into incredibly sophisticated hybrids. We've covered a ton of ground in this explainer today. We've seen how a financial system rooted in charity and the complete prohibition of interest can literally scale up to fund entire nations. We've seen how it penalizes defaults without actually profiting from them, and how seamlessly it integrates with the green fintech revolution. Which leaves us with a really compelling final thought. As the conventional financial world continues to grapple with wealth inequality and these endless boom and bust debt cycles, could the integration of these ancient ethical frameworks and cutting-edge fintech actually provide the blueprint for a more equitable global economy? It's a fascinating possibility, and for sure, one that's well worth paying attention to.